Hi everyone, welcome to Intelligent Investing Market Talks series. I'm April Tan, Chief Equity Strategist of COL Financial. Today we'll be taking a closer look at the Philippine consumer sector. While we came into 2025 expecting consumer companies to benefit from easing inflation and election spending, the latest earnings season tells a different story. In the second quarter, recurring profits of most consumer companies actually declined. Manufacturers struggled with elevated input prices, retailers faced margin pressures, and even restaurants, though resilient, weren't spared from rising costs. To help us make sense of these trends and what they mean for investors moving forward, I'm joined by COL's consumer analysts, Denise Joaquin and Rachelle Biacora, who will break down the key highlights, the challenges facing manufacturers, retailers, and restaurants, and which companies are best positioned as we head into the second half of the year. Thank you, ladies, for joining us in the show.
Thanks for having us, April.
Great to be here again.
Okay, so let me begin the questioning with you, Rachelle. So as I mentioned in the intro, 2025 is supposed to be a good year for consumers because of falling inflation and election spending. But that said, what is the reason why most companies in the second quarter still reported weak earnings?
Right. So actually, most consumer companies recorded high revenues this quarter, but high costs largely pulled down the results this quarter. So some consumer companies did benefit from some of the seasonal tailwinds, like you mentioned, the election season and also the earlier shift of the school year. But this quarter, we also saw the apparent impact of the trade uncertainties from the U.S. tariffs and also some weaker margins from higher commodity costs.
I see. So next, let me ask you, Denise, let's talk about the different sectors, and I'd like to begin with the manufacturers. So manufacturers posted a median profit decline of 9.4%, which is kind of surprising. I mean, what were the key drivers behind this weakness for manufacturers in particular?
Yeah, that's right. So for the manufacturers, what we noticed were actually quite diverging stories in terms of what happened in terms of top line and bottom line. We were anticipating that boost from the midterm elections. And we were saying for a while that since rice prices have stayed low, this would be good for the average Filipino consumer. And this actually did materialize in the sales results of the listed F&B manufacturers. So for Mondanisin and for URC, their revenue growth for the local core branded business actually picked up to 5% for both those names. For Century, quite similar story. Their core branded business was up 6%, a bit slower from 1Q, but this was still pretty resilient. And they did note that their branded business locally was still up double digits, but they were pulled down by the branded exports. So on that note, it was positive for the domestic business, but where we saw weakness was more of the international or the export markets. So this was apparent for, let's say, for DNL. Their domestic was doing pretty well, and that mostly offset the decline in exports, which are actually down again for the second quarter. And same story again for Century, since their domestic business was doing well, but the tuna OEM export also declined. So I think in that regard, we did see that kind of contrast between domestic strength and international or export weakness. And in terms of bottom line, all the manufacturers suffered in terms of their GPM because of high commodity prices.
I see. So for commodity prices, I remember reading your report where you talked about high coconut oil, palm oil, tuna, cocoa, and even coffee playing a big role in squeezing the margins. But I'm just curious if, maybe it was just a first half problem, and now that we're moving to the second half, it's no longer an issue. I mean, what do you think? I mean, have we seen the worst as far as these costs are concerned?
Alright. So the bad news is it doesn't look like the worst is over, and there might be more pain ahead for the listed F&B manufacturers. So yeah, you're right. The commodities that were a pain for the manufacturers were that specific group, and although there are some other commodities that are doing well or staying subdued, like wheat and sugar, right? It's the edible oils like coconut and palm oil that are still, well, it's elevated for coconut oil, barely moving. Palm oil has also jumped around 11% from recent lows. And yeah, I think the reason for those two is they're both substitutes of each other. So in a way, they influence each other's prices. And they're also both used in biodiesel, like coconut here and palm oil for Indonesia. So other than those two, coffee has also seen a rebound from recent lows in July. So we saw that 30% rebound from July to August. But yeah, I guess on the other hand, tuna has stayed relatively subdued. So it's quite flat or a bit better quarter on quarter.
I guess it depends. Like if they're a bit more dependent on coconut oil and palm oil, then they'll be more vulnerable, and maybe even coffee, no? Okay, so Rachel, now let's talk about the restaurants. So we only have two restaurants, Jollibee and Pizza. So how were the sales of those two restaurants during the second quarter? Were they actually stronger, like you had mentioned, compared to the first quarter, or, was it weaker?
Yeah, so the restaurants performed, I'd say, stronger this quarter, especially on the top line, with a median of around 14.4%. So this was really supported by double-digit system-wide sales growth. So these restaurants were able to sustain this kind of growth, I guess, on two fronts. So first would be on the expansion initiatives that the both companies had, and second would be on the resilient SSSG. So I guess tackling on the first end of the drivers, so the growth initiatives. For pizza, the system-wide sales growth was largely on the contributions of the newly opened branches. So if I'm not mistaken, they opened around 367 stores in the past 12 months. And on Jollibee naman, the system-wide sales growth was mostly on the Compost Coffee acquisition. So if you remember, Compost Coffee was acquired in the third quarter of last year. So if you compare it on a year-on-year basis, last year's base did not include it. So if you strip out the contribution of Compost, the top line growth would be 11.4% instead of 19.6%. Yeah. So I would say also that still good growth on Jollibee's end. So I guess that also brings me to the second driver, so the SSSG. And I'd say that both restaurants held up well for the SSSG. So for pizza, their SSSG inched up a bit to 3%, largely on the volume-driven strategy that they've adopted by really pushing their single-serving offerings. For Jollibee naman, the domestic SSSG slowed a bit due to the typhoons and the also recent school opening. But this was largely offset talaga by the better performance of the international. So the international SSSG is now 4.1%, if I'm not mistaken, versus 0.7% in the last quarter. So much improvement there.
So I'm quite surprised with the performance of international, considering that, Denise had mentioned that for the manufacturers, exports and international were weak, but for the case of Jollibee, it was actually strong. So what do they attribute the strength of international?
Yeah, so the performance of the international segment of GFC, I'd say, is a mixed bag. But notable recovery more on the China brands and also the coffee and tea brands. So I guess going through it, the coffee and tea brands, CBTL led most of the growth. and mostly the sales were on the newly revamped app that they had, which gained a bit of traction in Malaysia and in the US. China naman, they now have a positive SSSG after how many quarters of decline, and management attributed this to the more value-focused strategy that they've adopted, which really boosted their traffic. I guess notably then, Jollibee Vietnam is doing really well. They're now number one in market share in that country, despite being the third in store network. So doing really well. But on the flip side, Smash Burger is still underperforming a bit with a negative SSSG. Same with Tim Ho Wan, still underperforming with negative SSSG. So mixed bag, but still we see steady recovery in the international segment. And I guess as a whole, we were able to see that their net margin actually is now a positive 0.4%, whereas last quarter it was negative.
Yeah, I remember first quarter, I think Jollibee's net income was down. So
Yeah, of the yeah. Now it's actually the other way around, domestic and international.
domestic still not bad.
Yeah, I think least of their worries.
Jollibee had a strong, profit.
Yeah.
Well, not really strong profit. I remember the net income of Jollibee, the core net income is only up by 2.4 or 2.2, something like that, right? And then for pizza, profits are actually down. So again, why do we have this thing happening about these two companies with strong sales but weak net income? What happened?
So I think same trend as what I mentioned a while ago. Strong revenue. So I mentioned the restaurant revenues were at the teens level, but still heavily weighed down by the costs. So we can look at both companies. So for JFC, let's say, the high top line was really weighed down by the higher than expected inventory costs and store costs. But this was also offset by around 60 bp decrease in their OPEX to sales ratio. So this was what led to their at least modest growth for the quarter. Pizza on the other hand, also high COGS, so heavy expansion spending, and management also mentioned that they've been investing more on product upgrades, so like cheesier pizzas, also some menu improvements. But unlike Jollibee, on top of this, they have more pre-operating costs and depreciation costs because of their aggressive expansion efforts. So they weren't able to offset it. So, yeah.
Okay, so now I'll ask you, Denise, about the retailers. So I noticed that they were mixed, with PGOLD and RRHI actually reporting faster revenue growth in the second quarter. But then you have WLCON and SSI reporting weaker revenues during the same period. So what's the reason why their results were mixed?
Right. That's right. PGOLD and Robinsons, we believe they really saw the benefits of that midterm election boost. And seasonal tailwinds, like we discussed earlier, from the elections and the earlier shift in back to school. I think it's a lot riding as well on the stable, resilient demand for essentials that we've seen consistently over the last few quarters. But interestingly, for Robinsons, it was also their discretionary formats that saw like a stronger recovery. And the discretionary formats actually were able to outpace the growth in their more essential formats like the groceries and the drugstores for this quarter, despite fewer selling days from the timing of the Holy Week holidays. So I thought that was also a positive signal for Robinsons. For WLCON and SSI, they tell a bit of a different story, but for SSI, it's more company specific. So their sales declined about 1.6%, But this was more of an inventory issue that was caused by well, they had plans to transition into a new systems like ERP. Yeah. So actually, it's not really a unique problem since we've seen this. I think with URC like a year, in the past. So there was that, but also they cited weak demand across their portfolio, and it's the second quarter that their results have missed. So I think for the last 2 quarters, they've just been underperforming, and it has to do with their, I think, the demand for their portfolio right now. For WLCON, although their SSSG was optically worse, we also noticed that the steeper decline in SSSG coming from about -3% in 1Q to about 6% in 2Q. The difference largely corresponded with the timing of the Holy Week holidays. Since like WLCON as a discretionary retailer, they'd have to close their stores, I think, during the Easter holiday. So that just explains the difference. But for about 2 quarters now, their results actually fell in line with our forecast. So we think it might be signaling some stabilization or
Bottoming out.
yeah. Actually,
Yeah.
could be a signal for that.
Yeah, but I'm just curious why, like revenues are down, as you said, 1+% for both. I think max of 2, but net income was down quite a bit for both SSI and WLCON. I mean, why is the drop in net income much more substantial for both companies?
Right. So yeah, there's 3 factors that might explain that. Also, the first is, as a retailer, since you're running like a large network of stores, a small drop in net income would be amplified by, if you're running all these stores and, employing all these people, your fixed costs, they'd be a bit hard to bring down. So yeah, that causes like some negative operating leverage. And second, I guess for these 2 companies specifically as well, since demand isn't particularly strong, I think WLCON also has been trying to discount some of its merchandise. So there was weakness in GPM. So actually for both of them. And yeah, the third is they're also expanding, opening new stores for both those names. So that has some extra carry onto operating costs.
I see. So, now I'd like to move back to RRHI because, again, you talked about strong sales growth. I think it's 5.9%. But, net profits are down by 2.4%. Is this something that we should be worried about or not really?
Right. So yeah, we were talking about earlier how strong the revenues are, but a bit surprising why, based on our estimates, like core income was down a bit. But we noticed that this was largely because of tax timing differences. So actually, if we exclude or if we normalize the tax rate, core profits would have been up about 3.8%. So still a bit lower versus their high single-digit operating income. But I think this is something we can attribute to like extra borrowings. There's also an increase in short-term borrowings, I think, to fund working capital as well. But from our discussion during the last episode that we put together as well, we do expect that EPS accretion to materialize in the 3rd quarter since that will have the full impact of the share buyback.
Again, maybe you could refresh the viewers about like what happened in the share buyback and why would EPS grow and why should EPS be more important than actually just the net income?
Oh, that's right. So during the transaction that RRHI entered, I think a few months ago, they bought back about 20% of their outstanding shares. So this effectively reduces the denominator in the EPS calculation. Yes. So there is some negative carry from the interest expense that they'd have to pay out. But yeah, based on our estimates, overall it would still result in a higher effective EPS for investors. And yeah, essentially, I think this is a good proxy for your expectations or earnings, and yeah, it should be reflective on the share price, we believe.
So looking ahead to the second half of 2025, what's your outlook for the consumer sector? So let's just break it down to the three subsectors, the manufacturers, retailers, and restaurants. So let me begin with you this time, Denise. Maybe talk about manufacturers and retailers first.
Right. So for the manufacturers, I think we would continue to see that contrasting dynamic on domestic strength, maybe some weakness still on international. We noticed that, right, so after the Philippines and other countries negotiated their tariff rates, it seems like the advantage that the Philippines had of a lower tariff rate versus neighboring peers isn't really the same case anymore now. I think us and other neighboring countries have similar rates. So it's really more difficult to say that we'll see a rebound in exports. So there's a lot of uncertainty there. So adding to uncertainties with the international and export markets, we are also seeing some headwinds from high costs. So I think that's something that the manufacturers will still have to navigate for now. And for retailers, we do still think that they'll benefit from domestic strength and stable spending on essentials, some upside as well from discretionary spending if that can recover with stronger consumer confidence and still low inflation.
So in other words, more optimistic on the retailers rather than manufacturers.
Yes, for the sector, I think retailers generally would still be performing better.
So now let's talk about the restaurants. Rachel, what do you think? What's the outlook for the second half of 2025?
And with the international segment recovering, that's very much encouraging. But I would say that any upside from this segment is still uncertain since the operations are still normalizing. But in general, I think we still really need to keep an eye on the costs for if it would still weigh on the margin. So for example, if coffee prices still stay high for Jollibee or for pizza, the cost that they would incur if they ramp up on their expansion in the second half.
I see. So, and even maybe on the international, I mean, it seems to be a good bottom-up strategy. But I guess, for example, they're still encountering challenges in Smash Burger for Jollibee. I mean, it's just more difficult because the international environment is, I guess, more challenged, being more export dependent. So it's just going to be harder.
Yes.
So I can. So for my last question to you ladies, like you can choose who's going to answer. So what are your top picks or most attractive names that you would recommend to investors right now? I think Denise will be the one. Or
Yeah, we discussed this earlier.
Yeah.
To focus on PGOLD and RRHI, but with PGOLD having rallied by a lot, we think that Robinsons would be the more attractive opportunity at current levels, and Pure Gold would be more of a buy on dip opportunity if that.
Not right now.
Yeah, that's correct. So if that presents itself, buy on dips for PGOLD. So last time we also talked about how Monde was a very undervalued stock and that we were expecting recovery in its APAC PFP business. But yeah, we think that it still is undervalued and that its long-term prospects are attractive. But given the negative earnings surprise in the second quarter on margins and the pullback in URC's share price, this actually puts both Monde and URC at par with each other in terms of valuation. So both are trading at just 14 times PE, which is still pretty attractive. And but, considering this and that URC is a bigger cap name with a more diversified portfolio. We think that URC might actually be the more attractive buy on dip opportunity for now. And yeah, I think it would be prudent to just monitor, high coffee costs, since that still is a headwind. But we think this is also largely priced in. And I think at current levels, URC also offers an attractive dividend yield of around 4.7%. So I think that's something we can also consider.
So I think even compared to Monde, the dividend yield is higher.
Yes.
Which in a way makes it more attractive as well.
Yeah.
Okay, so with that, thank you very much, ladies, for sharing your thoughts on the consumer sector and giving the viewers a tip on which stocks are most attractive in the second half of 2025. Thank you so much.
Thank you.
Thank you.
That's it for this episode of Intelligent Investing. If you found this discussion useful, don't forget to like and subscribe for more market insights. And remember, stay sharp, stay selective, and as always, invest intelligently.